Uh, Welcome back to Strongman Personal Finance. We got a sponsored video today. And if you want a sponsored video, see the pinned comment on this live stream after the live stream ends. You send me $50 and I'll make a video about whatever you want. So I haven't streamed in a while, but I find it's actually very convenient to get things done. So we're going to review this stonk, which is a sponsored video called CUMmins. I'm coming for you, baby. I'm coming so hard. So what is CUMmins? Let's type in the stock first, which I did not do in preparation because I'm a piece of trash. CUMmins designs, manufactures, distributes, and services diesel and natural gas engines. Very exciting subject here. Electric and hybrid powertrains and related components worldwide. It operates through 5 segments: engine, distribution, components, power systems, and accelera. The company offers diesel and natural gas powered engines under the CUMmins and other customer brands for heavy and medium duty truck, bus, recreational, light duty, blah, 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 defense. Oh, I see defense there. Okay, it provides power generation systems, emission solutions, turbochargers, automated. They do a lot of crap. Okay, basically, it's a they're a manufacturer. They make and distribute engine and engine related products. So let's go ahead and look at the historical price action of this company. So it's up 106% over the past 5 years. And it's got a pretty decent dividend of 2.33%, which I guess is good because if you factor in the share price change and the dividends probably paid over the last 5 years, you've probably beaten the S&P 500. Had you fortuitously put your entire portfolio in CUMmins at exactly this time 5 years ago, which I'm sure Jeremy Lefebvre did. Okay. So let's go ahead and look at some valuations, my salutations. So it's basically more expensive than it's ever been. Okay, I guess we have a brief spike. That could have been because of anything. Could have been like a bad earnings report that messed up the trailing earnings. Price to sales. Okay, we're getting pricier. Price to books, we're as expensive as we've ever been. Price to free cash flow is as expensive as we've ever been. And price to operating cash flow as expensive as we've ever been. So there's a lot of metrics that are showing this company is expensive relative to history. And of course, with that expensiveness comes a pretty significant decrease in year-over-year revenue growth. So year-over-year revenue growth for the past couple of quarters is basically flat or negative. Okay, so the revenue has temporarily peaked. They've had some kind of revenue issues over the last couple of quarters. Overall revenue over time is up over the past 5 years from about $5 billion and change. I believe they had an acquisition. Okay, let's look at profit margins. Are they expanding or contracting? Well, gross margin is your profit from selling items, excluding other operating expenses. That's basically stayed flat over the past 5 years. So, I mean, they're not losing margin. That's good. Operating margin, basically the same. And profit margin, basically the same. Now, earnings per share seems to be trending up a little bit, okay? So, at the end of the day, you want to look at earnings per share because you want to look at your earnings as an individual shareholder. Now, earnings per share goes up because the underlying total profit of the business has gone up. And or because the company's buying back shares. So if there's fewer shares outstanding, you get a bigger percentage of the profits. That's why companies do buybacks. We can see they're slowly doing buybacks. They're also doing a dividend. Let's see the dividend growth. Dividend per share, excuse me. So they have a growing dividend. They pay a decent dividend. And they've done share buyback. So that's like actual returns to you as the shareholder. You buy a business. How do you make money? Well, the business makes profits, it reinvests it, or they pay a dividend, which is cash being returned to you as the shareholder. That's all it is. Or they reduce the total ownership, the total float of the company, which means your percentage ownership of the company in all its profits, future profits has increased. So this company is providing real returns. Okay, they are providing a real dividend, and they are providing real share buybacks. The main thing that I'm worried about, or not even worried about, but is they've recently had some flatlining of revenue, but it's not the worst thing in the world. So we're going to look at the balance sheet on the actual report later. I'm just looking at overall trends. Operating cash flow is negative for the most recent quarter. It could just be a timing thing. Maybe they had a huge investment in inventory or something, or they paid off a bunch of short-term debt all at once for whatever reason. It could be anything, but operating cash flow for the last quarter is negative. So I guess we'll see more about why. But historically, it's been positive. Let's see. Capital expenditures. Okay, seems to be about normal. Cash acquisition. So they did have an acquisition back in the third quarter of 2022. Divestitures. So it looks like they had a cash outflow. Why would a divestiture be negative? I don't understand that. That sounds like an acquisition to me. But they had a negative outflow of $174 million for a divestiture. Okay. Usually when you divest, you sell something, you get cash coming in. Maybe I'm stupid. Okay. They just packed on a huge amount of debt in the first quarter of 2024. And why did they do that? Okay. I don't see any huge increase in capital expenditures. I don't see any huge increase in investments. Why did they issue a bunch of debt? I don't know. We'll see on the actual financial report. That's why you got to look at the financial report. Now, the free cash flow per share has, until recently, they had pretty decent free cash flow per share. But with that one quarter of bad operating cash flow, that definitely hurt their free cash flow per share. Okay. But you can see over time that, I guess it's over time it's grown. So let's go look at the actual report. Let's see, we can glean from this engine maker. Okay. So this is the report for the 3 months into June 30th, 2024. So we see net sales is up very, very slightly. They had a very, very, very slight increase in sales. So this is not like at least recently, this hasn't been like a super revenue growing business. Their sales grew by 87.96, 863. By 1.8%, and their gross profit, which is their profit from just selling their engines and stuff, has grown by 2%. So their profits grew slightly faster than their revenue. Their gross profits did. Selling, general, and admin, they made some cuts there. R&D, some slight cuts, but nothing crazy. Equity, royalty, and interest income from investees. So this company has investments in other businesses, but they don't control them. And when those businesses, underlying businesses, have profits, those profits get recorded on the income statement of the parent company, basically. So equity, royalty, whatever they freaking know. We'll look at the notes in a little bit. They had basically a little bit of decline from the prior quarter. It could be for any number of reasons. For a total operating income of $1 billion. Yeah, $1 billion in the last 3 months. So their operating margin, you take their operating income divided by their net sales, 12%. That's healthy. Nothing crazy there. Interest expense. So they make $1,000 in profit. Now, you as the stockholder, you don't get all the cash, all the profits, because the debt holders have to be paid first. So about 10% of the operating profits get eaten up by debt, leaving 90% for taxes and then to you. So then the government comes and gets their share, the government, and then finally you as the shareholder get the net income attributable to CUMmins of $726. So their bottom line profit that goes to the shareholder. Basically about 27 or 25% of the operating profit gets taken by debt and government. Oh, what am I doing? 726 divided by 8796. So their bottom line profit margin is 8.25%. So, they're making money. Their earnings per share grew. They bought back shares. They're paying a dividend. This is, I've seen worse businesses. Okay. At least they make money. All right, let's look at their balance sheet. Because I think, I'm going to share my screen. Yeah. I think what should we call it? Stock analysis. There's something off with this. I was looking at it earlier. I think that's why you got to check the actual reports, because I think there's some issues with that for that particular company. All right, so total cash. Now remember, there's different types of short-term assets. Some short-term assets are cash or can be quickly converted to cash, whereas other ones cannot. So when you're looking at if a company can pay its short-term bills, you want to look at the more liquid amounts, because if a company's having trouble selling inventory, even though it's a current asset, that doesn't mean it's going to be quick converted to cash to pay short-term debts. But they got $2.1 billion of cash and marketable securities, very liquid, that they have access to. And then they have $5.6 billion of accounts and notes receivables. This is payments due from customers, or basically investments of other debt that they've made, or notes receivables, basically just money that's owed to them that's due within a year, of 5.6. So overall, their very liquid capital is roughly $7.7 billion. Their current debts, mostly accounts payable and commercial paper. This is like short-term corporate debt. And let's see, current maturities of long-term debt, accrued compensation, current portion of accrued product warranty. Let's see. If we take out deferred revenue, then they have probably about 10 billion due within the next year. So very liquid, they have 7.7, and due within a year, they have 10 billion. So not the greatest, but this is a cash flow positive business. So they'll probably be able to pay their short-term debts. You can usually, sometimes you'll see a company's liquidity ratios won't be that great, but then you look at it, historical amounts, and they seem to run at about a 0.7 quick ratio. This is the very stringent test. And then their current ratio is 1.34. So this isn't like imminent crisis. They have more current assets overall than current liabilities, and they have about a decent amount of liquid capital. So I don't think they're going to go bust in the next year, unless something crazy happens. Let's just something off the balance sheet. All right. Property, plant, equipment. So it looks like they sold some. And they've used up approximately 46% of their long-term assets. So you want to track accumulated depreciation, because that tells you how old the assets are. And if it's accumulated depreciation is almost the same as property, plant, and equipment, they might have to replace their assets pretty soon. So they've in the aggregate used up about half of their assets, but that can kind of indicate future capital expenditures in the future. But it's not the worst. It's not as bad as GameStop. Investments and equity. So this is investments in other companies. They bought a stake in another company, but they don't control it. And this fluctuates up and down depending on how those underlying companies perform. So those companies record a profit, and CUMmins owns 20% of it. CUMmins recognizes 20% of the profit on their income statement, and they gross this account up on their balance sheet. And if they get a dividend, that reduces it. They get the cash and they credit the investment account. So that went up a little bit. So their underlying ownership businesses they own probably recorded profits. Goodwill went down a little bit. So goodwill is when you buy a company more than the fair value of its net assets, but it's not a huge part of their total assets. Pension assets. Oh, get out of here. God, pensions are such a freaking scam. So overall, they mostly have tangible assets besides the goodwill, and they have about 25 billion of tangible assets versus 20 billion overall of total debts. So that's not the worst. Long-term debt. Okay, they took out some long-term debt. Deferred revenue is cash they've received in advance that they haven't earned yet. They haven't performed the service. So while it's technically a debt, there's probably not going to be cancellations. It doesn't really count. But they have 5.4 billion of long-term debt, but they have more long-term assets, tangible long-term assets, than they have long-term debt. And other liabilities, which I don't know what that is, but we'll see later. 3.1 billion. So common stock, we see that's gone up because they're probably issuing shares for like stock-based compensation, but then they buy shares back to compensate for that. Retained earnings is up. That means they recorded profits. Treasury stock is up. When you see treasury stock become more negative, that means they 30,000 issues with my computer. Okay. Oh shit. 30, that was a thumbnail I was making. 30,000 issues with my computer. Treasury stocks, when they buy back stock, it becomes more negative. It just represents the cash they paid to buy back the stock. And then other accumulated comprehensive loss is just some very specific things. But overall, I mean, their balance sheet's fine. They have plenty of liquid capital to pay their short-term debts. They have, mostly tangible long-term assets. And they don't have an insane amount of long-term debt, and it's due at least outside of a year. All right, statement of cash flows. Why do we have... Okay, so the reason they had... What is this? Gain related to divestiture of Atmos. Okay, so in the last 6 months, they recorded a $1.1 billion, $1.3 billion gain on divesting of Atmos, my Schlattness. So... it's subtracted out because gains are non-cash on the statement of cash flows. It gets subtracted out to reconcile between GAAP profits and operating cash flow. So they took that out. Let's see. And accrued expenses. So this is why they basically paid off a bunch of short-term debts, which is why the cash flow was so negative. That's why that looks like that one blip of operating cash flow going negative. So we're going to see the notes. I guess we'll see what that's all about. But that's why the operating cash flow is negative, because they paid off a bunch of short-term accrued expenses or debts. It could have been related to the divestiture maybe, but that's why it's negative. But I don't think that's going to continue. I don't think they're going to keep paying that huge amount every freaking quarter because they would literally pay off all their short-term debts. Capital expenditures, this is buying long-term stuff, no real change. Cash associated with Altmis divestiture. Okay. Proceeds from borrowing. So they borrowed $2.4 billion. And they paid $1.2 billion. Dividends are up. Why do they borrow money? I don't know if it's anticipation of something or what's going on here, but they borrowed a bunch of freaking money, and I don't really see why they did that. I mean, they divested a business, so maybe they'll tell us later. All right, so statement of cash flows. The only main thing I see is this huge. The big items are the gain that they subtracted out because it's a reconciliation between accrual and cash, and then this very large payment of accrued expense. I guess that's what they borrowed the cash for. That has to be the only reason. They borrowed $2.4 billion of cash, long-term debt, to pay these accrued expenses. I don't know if this was... I'm not sure what this was. We'll see. But that looks like why they borrowed it. All right. Divestiture of Atmos. We completed the divestiture of our remaining 80.5% ownership of Atmos Filtration Technologies common stock through a tax-free split off. Okay. Settlement agreements. I think we're getting to the root of the cause here. We announced that we reached an agreement in principle with the U.S. EPA, California, regarding our emissions certification and compliance process for certain engines primarily used in pickup truck, which can final. In the second quarter, we made $1.9 billion of payments required. Okay, so they got dinged by the government. That's why they had to borrow freaking money. I don't know. Is this going to happen in the future? We'll see. That's a little concerning. The government's clapped their butt cheeks over emissions. Their board probably wasn't diverse enough. Revenue, long-term contracts, deferred revenue, disaggregation of revenue. So where does most of our revenue come from? Well, roughly 58% of their revenue comes from America. And China is 87.96. 8.5%. And then other international, 28%. So basically, more than half of their revenue comes from the US, but they're globally diversified with a decent chunk outside of China and India. Okay, interesting to know. Components segment external sales, drivetrain and braking systems. Wow, 1.2 billion. Emission solutions, 800 million. Components, 279. Automated transmission. Atmos, gone. Freaking gone. So we can see that revenue is down for every type of external sales. Components segment external sales by business. So drivetrain, emission, components, automated, all of these are down year over year. Maybe that's because of the Atmos divestiture. I don't know. The engine segment external sales. Let's see. Okay, that's up year over year for heavy trucks, medium trucks, and light trucks. Besides off-highway. So engine sales are mostly up. Distribution segment sales by region. Basically up for everywhere except Africa and the Middle East. Oh my God. For distribution. Parts down, power generation up. Okay, I mean, like basically, some of their stuff they've increased revenue and some of it they've decreased. I don't see any like huge issues there. The fine is what I would be worried about. Okay, equity, royalty, and interest income. So who are they invested in? Chongqing CUMmins Engine Company, Dong, I like that one, Dongfeng, Beijing Photon, Tata, that's India, I think. Let's see. So basically all their sub-businesses are making profits. Good, wonderful. Let's see. Debt mutual funds, CDs, and equity mutual funds. Okay, this is basically where they have their money invested. Mutual fund, growth stock mutual funds. Okay. Debt. Loans paid. We can issue up to $4 billion of unsecured short-term promissory notes. Let's see. Long-term debts. When's their long-term debt coming due? Well, it looks like most of it ain't due for a freaking while. Okay, you can see like the biggest chunk of long-term debt is due in 2054. We got 2028, 2029, 2030, 2035. And the interest rates really aren't that crazy. They're really not. So I don't see any huge like upcoming catastrophes for long-term debt. I mean, they got about $760 million due within the next couple of years. I think they can make those payments. Let's see. Legal proceedings. Because they only just had to pay $1.1 billion or whatever. $1.9 billion. We are subject to numerous lawsuits and claims rising out of the ordinary course of our business. Let's see. Okay, so we already know they got shafted in the bunghole by the government for, let's see. We announced this part of the settlement. Failure to comply. We recorded a charge of $2 billion to resolve the matters addressed by the settlement. God, man, they're just getting slammed. Okay, so apparently some kind of emissions dispute. So, I mean, overall, I don't see any like major red flags for the company besides their legal liability. So you got to really, that's something you really can't anticipate, in my opinion. I would be worried about that. Okay, they got rid of this Atmos thing, but no crazy red flags for the business overall. So they're globally diversified, profitable. They're paying dividends. They're doing share buybacks. This is better than Tattooed Chef. Okay. Let's do some comments. Do everybody like that? You like the sponsored videos? You pay me $50. I'll do a sponsored video for you. Thanks for the stop. Is it a stock buy recommendation? Sean, who knows a lot about CUMmins. That's right, I do. I got two hands. As long as Mint exists, there will be a lot of CUMmins. I'm bullish for the long term. Strong man. It's just easier to do. Let's see. Goodwill is clown assets, basically. My brother and teacher, I work at CUMmins, global supplier, quality solutions. Oh, that's cool. I should hook you up with the guy that requested this. Dong thing dividend. I'm CMI. Is Dong yield just return of capital? No. I mean, they make profits. They have retained earnings. This isn't yield max. All right, so that's CUMmins stock. If you want a sponsored video, see the pinned comment below. I'm going to do another live because I have another sponsored video to do. And then we're going to, I don't know, have a wonderful day. Cheers.